Welcome back to the Surrey Report for July. I'm back with Chandani. These are our best videos. You guys like them the best, so we're going to do it this way. It is going to be a topic all about the banks, specifically 3 things that the banks are doing with your money that you didn't know they were doing. But that's going to be on the back side of the stats. First, here are the stats for Surrey combined.
Starting off with our detached market, the benchmark price is $1,089,500. That is up 3.1% year over year and 0.2% month over month.
And in condos, the benchmark price has just crested $400,000. That's a 4.6% increase year over year and a 0.3% increase month over month.
And for townhouses in June, we have an average price of $583,600. That's a 2.1% increase year over year and 0.9% increase month over month.
Okay, so when we're getting mortgages out there, we think we know what we're getting, but do we actually know? Are we actually reading the fine print? So here are a couple questions just to clarify the things that we might not know is going on out there.
Yeah, 3 big things that I think people should know about when they are signing off on their mortgage that they really have no idea about whatsoever.
Okay, so first one, total indebtedness.
Yes.
Okay, what is it and why should I care?
Okay, so total indebtedness is, if you get a mortgage from the bank, usually they'll have a clause that says, that's referred to as total indebtedness. What that means is you have a mortgage with them, but you may also have, let's say, a line of credit with them or a car loan with them or any other Visa, whatever it happens to be. And if you default on one or all of those, they can then call all of the debt that you owe them. So let's say, for instance, you can't make your mortgage payment or you have some sort of trouble with your mortgage payment. When you go to clear up that mortgage, they could in fact call your car loan at the same time and make you, when say for instance you had to sell your property to clear up your mortgage, you may have to pay back your car loan as well, your credit cards, and vice versa. Now I have never seen one actually induced. I've never seen the clause taken advantage of. But it would worry me if I was having trouble making my credit card payments that they may be able to call my mortgage. So they can call total indebtedness for everything I owe to one bank. So a solution for this that I have personally, and I recommend people do, credit card at one bank, mortgage at another bank, line of credit maybe at another bank, car loan at another bank. Hopefully you don't have that much debt, but if you do, try and spread it around a little bit so one company doesn't have a lockdown on all of your debt.
Makes sense. Okay, so collateral mortgage. What is it? And why do banks default to them over traditional mortgages?
Okay, so a collateral mortgage is explained this way. If I gave Chandani this example earlier. If you bought a place for $500,000 and you put 20% down, your mortgage would be $400,000. So when the bank goes to register your mortgage on title, you figure their charge would say their charge is worth $400,000. Because that's how big your mortgage is. That's called a traditional mortgage.
Yeah.
A collateral mortgage is actually where they register it to 100%, so $500,000, or 125%, which could be as much as over $600,000.
Yeah.
So here's their sales pitch of why this is good for you. Because, Chandani, if you need any extra money, you don't have to go to the lawyers. You don't have to reapply. You can just come back to us, and we can do it internally and lend you more money.
Okay.
All right.
But why does it benefit them?
Why does it benefit them? Because now they've done what I call clogging up their title. Until my property is worth over that 500 or 600 or whatever the collateral percentage is, I can't borrow money from anybody else against my property. Okay. So if I did want to go and get a line of credit with another company, they would look at the title and go, well, the first 600,000 is possibly owing to this guy.
Right, yeah.
It's only worth 500.
Yeah.
We're not going to lend you any money.
That makes sense.
Go back to your original bank. So again, it limits your ability to do or have free access to gaining the own capital that you own down to one bank. Now, these banks will put these things in. There's nothing we can really do about it. We can request that they're not, but most banks, these are going by default, and that's why they're doing it by default. So they can have first access to your next business.
Interesting. So ask your mortgage broker when you're doing this.
Ask your mortgage broker, and for sure, my experience was I asked for it not to be in, and by the time the fine print actually came through, the bank was like, take it or leave it. So unfortunately, you just have to know it is there.
Yeah. Buyer beware. Okay, so avoid CMHC. So many of our buyers save up 20%, right? Because they feel that they're going to avoid the mortgage insurance premium.
Yes.
Okay. So why might that be a waste of time?
It may be a waste of time. It usually is a waste of time.
Why is that?
So everybody says, I'm going to save up. I'm going to buy a house for $800,000.
Yeah.
I'm going to put my 20% down. You may as well, in my opinion, put down 15% or 5%. It does make your payment lower.
Yeah.
However, you are doing the 20% to avoid the CMHC premium,
Insurance.
which, you know, could be anywhere $7,000, $8,000, $10,000, $15,000 topped up on top of your mortgage.
Yeah.
Except if you fall into CMHC rules, which is purchasing under $1 million, basically, for your principal residence, all these different things, and the CMHC is insurable, the bank will still take out that insurance.
Yeah.
They just won't tell you. So, for instance, I'll give you an example. You're buying a place for $800,000. Your interest rate is 2.49%. If you are 5 to 15% down.
Yep.
As soon as you go 20% down, you avoided, let's call it a $15,000 CMHC fee.
Yep.
And now you're getting charged 2.89% on your mortgage.
So you're getting the higher interest rate.
So you're getting a higher interest rate. Why are you getting a higher interest rate? Because the bank is buying that CMHC product, limiting their or removing completely any liability they may have if you default, and then they're back end loading it. So they're not telling you they're buying the CMHC fee. They are just buying it anyway and charging you through a higher interest rate.
So at the end, the bank is still getting.
Oh, the bank's going to get their money,
They're
and they're
getting
not going
the
to
money.
take on any
Yeah.
risk,
Yeah.
is basically what's happening.
So what the best thing people should do is talk to their mortgage broker and say, hey, if I put down 15% versus 18 versus 20, 22, ask those questions and see what's kind of the best strategy.
Yeah, because you may find out. And then once you're over $1 million, it doesn't matter anyway.
You need
and
20.
then you'll often get an even worse interest rate because now they're taking on also liability, right? So these are all things that you have to consider that you didn't know were happening with your mortgage. You thought you were being a good little mortgagor, and turns out the bank's doing all sorts of stuff behind your back. All right? Does that make sense?
Yeah.
Answer your questions? Any other questions? Forever hold your peace?
No, I'm good.
Okay. Awesome. Thanks so much for joining us this month. We'll see you next month on the Surrey Report.
Bye for now.
Are you sick of your mortgage altogether? Thinking about downsizing? Getting rid of it? Well, go back and watch the time I met with realtor Anita Painter in beautiful Campbell River, BC, to talk all about moving from the big city to a small town and the affordability that goes along with it. Thanks for watching the Surrey Report. We'll see you next month.
Okay, my hands are so wet. Look, please look.
I don't want to touch your hands.
You have to look, though.
Distance. Social
You
distance.
need to look.
No.